Hello guys, my name is Mubashir Ansari. Today we are going to analyze the stock which is going through too many news because of it, it drops by the 30% of the day before yesterday, and yesterday it was a fallback uh, uh, around 7%, maybe it was a fallback around 7%. So let's find out the reason behind that and in-depth analysis of that stock. Let's go through the technicals of that stock first. So first, let's see the Nifty levels, Nifty 50 levels. Okay, so Nifty 50 is continuously going down. The reason look like okay. It looks like next support will be around 24,700. Okay, 24,700, and the current price is 24,800. And here maybe the order block form. That's why I have marked with it. Okay. Okay. This level was actually the support and resistance support level. Now let's see, but it is we can say that weak support level. Let's see it already get out touched by the support level is already get here. So yes, where market consolidate. Actually my mouse is not working well, and I saw the touchpad. Anyways, let's see the technicals of the Indian Exchange Commission, Indian Energy Exchange. Okay. Okay, let's go with the weekly chart. Okay. As we are looking, we are going to see if the stock is good for the long term or not. Okay. So basically, the stock is actually doing good. If we see the weekly chart, let's go with the monthly chart. Yeah, the stock is doing very good. It was we can say it was listed on the market around in 2017. Till now it has given the return of around, if we compare with the current levels, 200%. That's not bad. It is a good. If we look at the all-time high of this stock, then it was around 500%. Okay, let's closely analyze the stock before moving towards the stock analysis. Day chart, we want day chart actually. Okay. So the stock drop around in 24 July, but we can observe that it was slowly dropping from one week. That means some insiders having a, we cannot directly blame, but maybe there are people who already knows that there will be a very bad news for that stock. That's why they have sold their stock. Okay, sold their shares. So let's now analyze the company. Before that, let's see what was the major news for that stock which leads to the great fall for Indian Energy Exchange. different interest region. Okay, looks like something is going wrong here. Okay, let's add that and now let's try again. Okay, now market coupling. So the major news was that market coupling regulatory shock. Okay, the CERC, okay, the Central Electricity Regulatory Commission issued a directive to implement power market coupling, scheduled to start with the day-ahead market by January 2026. This means the centralized price discovery across all power trading platforms, undermining Indian Energy Exchange dominance in price settling and liquidity. Okay, loss of competitive mode. Indian Energy Exchange has historically had around 85 to 90% share of the day-ahead market and real-time market, generating 70 to 80% of its revenue from transaction. Okay, so basically they are going to lose around 80 to 90% shares of day-ahead market and real-time market. Okay, which was their main revenue source, as they are generating 70 to 80% revenue from transaction phase. That's a very major news for them. That's why stock was down by the around 21%. And if you look at the actual drop which from started from here, it was dropped by the around 35%. Okay, so anyways, that was a very bad news. And the fallback, the reason the stock was rebounded after the drop, it was because the quarter one of financial year 2026 results that leads to the rebound of the stock because of the quarter one strong earnings results. Okay, technical results also levels. Also it was a oversold stock, that's why it was bounded back. Okay, so let's analyze the stock. So basically it is a small cap, we can say. It is having a 30,000 market cap, 30,000 crore market cap. Stock is 29 and the industry is 73. That's great. That means the stock is trading below the industry average P. Okay, return on capital employed is 53.6%. That's huge because it is a electricity based company, and they don't have to incur the huge expenses towards the plant and machinery. That's why they can have this much of return on capital employed. They have ROE, return on equity is around 40%. That's good. That means they have uh, that also. That's why they are having a great um, more return on capital. Promoter holding has been not changed. That's good. Interest coverage is too much high. That's good. Number of equity share. Okay, EPS growth of the 5 years is quite good, acceptable, quick ratio and current ratio. That means they are having no inventory held with them. Okay, that's good sign. Current price and the book value is that. Okay, that means the current market price is 10 times of the book value. Okay, around 11.8. Okay. uh, Debt to equity, that means they are highly having any debt. They don't even have debt, we can say. Debt free company. This is a debt free company. Okay. Sales growth of 45 years also good. EPS growth for the 10 years is also good, and average dividend payout 53.4%. That's huge. Means they are paying 53.4% out of their profit. Okay. Dividend yield means if you compare that dividend payout comparing with the current stock price, the dividend payout is 2.07% of the current market price. Face value is 1. EV to EBITDA is quite high, as a company is having a 20 company is trading at 21.4 times of its current core profit. PAG ratio is quite high. Industry price to book value is 21.8 and the company is having a 11.8, means half of that. Okay, that's great. That's great. That's not bad. Let's see the EPS. Uh, let's see the EPS growth along with the PE. Okay. So let's start with the 2020 5 years data. We want 5 years data. At that time the PE was the around 36 and the EPS was 2. Okay, and the current PE is 38. The EPS is quite acceptable. It is growing, and the current EPS is quite 39, and EPS means that company is doing great. Their EPS has been growing and their P is going down. That's the sign of a company is undervalued if you consider the EPS and P growth. Now let me check it is recording. Okay, multi commodities. Okay, quarterly results. Let's see the quarterly results of the company. So we can see that over there is a hardly any negative year on year sales growth, means company is doing very good. In June 2022 to June 2025, within 3 years company has nearly did 1.4x, has grown by the 40%, has grown their profit by the 40%. Okay, from 98 to 140. Expenses, let's see their percentage. Looks like their efficiency has been reducing because initially they are doing less expensive at 8.14 towards the employees. Now it will become 8.55%. Operating profit margin, let's see. Operating profit margin looks like quite fluctuating maybe because of the government policies and all. Interest obligation is been same of 1 crore. Depreciation also being same 5 crores. Tax is looks like they are paying tax on time. They don't have any tax liabilities. Their profit growth over the 3 years from 70 to 113 is grown by, we can say, 60-70%. Okay, that's good. Let's see sales growth, profit and loss account, income statement for the, we can say, 10 years. Within 10 years they have nearly we can say 2 point increases their sale from 174 to 535, around 250%. Okay, that's good. They are continuously increasing. There is a steady growth. Looks like in this quarter they have in this year they have only negative growth. Apart from that, all the years have a very steady growth. That's a very good sign for that company. Operating profit margin also been increasing over the years. That's a very good thing. Interest obligation is quite low and depreciation obligation has been increasing. That means it can be because of they have increased their machinery. They have heavily invested in plant and machinery, which leads to the increase in plant and machinery and interest depreciation obligation. Dividend payout of they are consistently paying dividends. That's good. Compounded sales growth for the 10 years is 12%. That's good. Compounded profit growth is 18%. That's very nice. Stock price AGR for the 5 years is 20%. That's quite good return. Return on equity for the 10 years 42%. That's good. Now let's go with the balance sheet. Looks like they are raising money equity. They are not borrowing money, but they are raising money by issuing shares. We can see, equity capital has been increasing over the years. Reserve, they have approx they have increasing their reserve by the four, we can say 4 times over the years. That's very good sign. Borrowings, they have very less borrowing. Short-term borrowings, okay. Lease liabilities, they have lease liabilities. That's very good. We cannot even take this as a borrowing, because lease liability is not a liability that they have that's not a big headache for the company. In short, buildings has been increasing. As I said, they are maybe investing heavily in plants and machinery and buildings, because of which the depreciation expenses has been increased over the years. Okay. Equipments, okay. Computers, okay. They are they have invested in computers. Furnitures, they haven't invested. Intangible assets, maybe goodwill and patents and all, they have increased their goodwill in intangible assets. Okay. Accumulated depreciation. Okay. Current work in progress is capital work in progress is 3 crores. Okay. Maybe there is some their capital is being developed. Okay. Investment, they are increasing their investment over there. That's a very good sign. Trade receivables is quite high for the 2024, and but it is reduced. Okay. Only 2 crores. Cash and cash equivalents has been increasing. Okay, that's good. That's not a big concern. Let's see the operating cash flow. So basically, company has generated 7 and 8. Sorry, 3367 and around 1200 crores within these 3 years. Let's see the profit after tax. Around the company has a 7 and 15. Okay, so means company is doing cash sale. We can say that because they are not just selling, they are also recovering the cash from the customers. Receivables also has been reduced. Okay, receivable has been reduced from 79 to only 1 crores. Okay, payables has been increasing. That's a very bad sign for the company. Okay, investing, actually let's see where the company is investing. Fixed assets purchase, okay. Company is continuously investing in the fixed assets. Investment purchase, okay. That's a very good area. I already saw in the balance sheet that the company is continuously purchasing the fixed assets. Dividend receipt, okay. Let's see from where company is getting the money. Proceed from the shares, okay. But we saw that the company is generating money. Company has been issuing shares to to increase their capital, but here we can there should be a amount for that. Is very bad things. Okay. Dividend paid, as we can observe that the company is consistently paying the dividend. Okay. Let's see the debtors. Yes, we can observe that there it is too much fluctuating, but company have less, majority of the time less than 90%, 90 days debtor days. That's a good sign. And there are no inventory days and days paid. That's good. Okay. Let's see what financial institutions do. Financial institutional investors are doing with this stock. They have increased their stake from we can say 24 March 24 to June 2025. They have increased around 80%. 8%. That's very good. Domestic and institutional investor also increase their stake in the company. That's very good. Public, public is look like public are selling the stock over the years. Initially, they were having a huge stake in the company. Let's see. Recent most important news for the company. As we already saw, the CERC, Centralized Electricity Regulatory Commission, has mandated a phase market coupling implementation power exchange starting Jan 2026, enhancing market efficiency. Basically, they want to centralize the pricing process, and initially it was done by the different exchanges, like in our case we can say Indian Energy Exchange. Now they don't have power to do that. Basically, let's see the segment in which but it plays the major role for their revenue for the Indian Energy Exchange to earn money by the fees and all. But now they are not going to earn through that. Let's see what more they can do. Okay, the Premium Energy Exchange, the company is India's premium electricity exchange with 85% market share. Okay, of 9 months, nationwide as another trading platform for the physical delivery of electricity, renewable power, renewable energy certification, and energy saving certificate. Okay, market segment, they had market already saw that they are not going to perform this task anymore. Certification, maybe they can do certification, but it plays only 11% of their revenue, we can say. Energy saving certificates, they issue energy saving certificates, but they generate very less, we can say, revenue for the company. Let's ask the ChatGPT what more they can do. Let's see what ChatGPT says. You are absolutely right. The sales market capping reforms is major structure is for the Indian Energy Exchange traditional business model. But will the regulatory threat is real? Is not necessarily the end of the okay. Let's see. It says current challenge loss of price power. Okay, obviously they lost the price power. Price discovery will be done by the central agency, Grid India, not by IEX. All orders from the exchange will be aggregated and single market clearing price will be applied. This eliminates the competitive edge Indian Energy Exchange had in price efficiency, liquidity, and high transaction value. Okay, them and they had market and the real-time market make up the 75% of the Indian Energy Exchange revenue. Revenue reduced decline and stagnate due to potential migration of the volume to the competitive pressure on transition to gas exchange become more like facilitator than the market maker. Okay, they are not the, we can say, they are not a market maker anymore. Strategic moves, how Indian Energy Exchange may adapt diversification into the new market segment. They can diversify into the new market segment basically. Okay, green day ahead market, they can go with the green day ahead market. Okay, renewable. Basically, ChatGPT is suggesting they can go with the renewable energy trading. Revenue potential moderate, fast growing but niche now. Okay, energy derivatives under development with the Indian INX. Okay, basically Indian INX also already developing the energy derivatives, which is already in under development. revenue, they can generate high revenue from that because it is obviously the derivatives market generates huge revenue. Long duration contracts, term ahead market contract of and they can go with the long duration contracts. Cross border electricity trade, that can also be done. Capacity markets, expansion of carbon and renewable credits. Okay, technology platform as a service and analytics. Okay, basically ChatGPT is suggesting what they can do to in order to generate revenue, because they are not now they are not in a condition to generate excellent revenue that they are doing in a past year, because of they were having a control over the price. Now they don't have any control over the price. So basically, as per my recommendation, it will be a good idea to keep yourself away from this stock for now. As For now, this stock is too much risky, because they haven't announced any idea for their incoming quarters and years, what they are going to do to generate more revenue, as they are not in a condition to generate more revenue, because they lost their major source of revenue. So thank you for watching. Have a nice day.